Welcome to the second part of the financial statements and ratio analysis. In this part, we are going to look at three goals. We will discuss the relationship between debt and financial leverage and the ratios used to analyze a firm's debt. We'll also use ratios to analyze a firm's profitability and its market value. We'll use a summary of financial ratios and the DuPont system of analysis to perform a complete ratio analysis. These are some of the very wonderful tools that you're going to learn in this course, in this session. First, we begin with an example of assessing debt impact. Now, P is incorporating her new business. She needs an initial investment of $50,000. She's considering a no debt plan under which she would invest the full amount without borrowing. The second option, the debt plan, involves investing $25,000 and balancing the remainder at 12%. So this is the interest rate that she is going to pay. Now, we expect $30,000 in sales and $18,000 operating expenses and has a tax rate of 40%. We want to assess which plan is better and what is the impact. Now, if you look at the financial statement, we have current assets, we have a no debt plan, and we have a debt plan with debt and without debt. Now, we look at the impact on both balance sheet and income statement. In balance sheet, the current assets 20,000 is the same, fixed assets are same, total assets are same. However, if we borrow debt at 12%, we will have a liability here of 25,000 for which we have to pay 12% interest. Now, if you look at it, we have equity. If it's 25,000 here, in here we have to put this 25,000 on our own through equity. So no debt plan, we put from our own pocket, and in debt plan we borrow. And so this is the borrowing. What impact it will have on the income statement? You can see that in sales we have same less operating expenses. They are the same for both $18,000, operating profits $12,000 for both under both plans. Then we have interest expense. Now in a no debt plan we have no interest because we have zero debt. We have zero debt. But here we have a debt, so we will have an interest also at a 12%, and that comes out to be $3,000. Now this reduces the net profits before taxes to 9,000. And if you can see, with no debt plan we have 12,000. Now it appears that net profit before taxes is reduced, and it's a bad thing if we borrow. However, this is not a complete story. When we move forward in the next step from net profit to less taxes, we see that the amount that is the amount that we borrowed and we paid as an interest will be tax deductible, which means we don't have to pay tax on it. So 3,000 is 9,000. On 9,000 we will have a lower tax, 40% comes out to be of 9,000 3,600, while here it is 4,800. So we are paying higher tax if we put our own money, and we'll pay low tax if we borrow the money. This tax advantage gives debt plan a benefit compared to no debt plan. You see, net profit after taxes is 7,200, so there are higher profits that they can earn. However, with the debt plan they have lower profits. Now it again appears that profits are higher, so no debt plan should be preferred. But when you calculate the return on equity is basically the total profit, $7,200, divided by the number of the amount that has been invested, 50,000. Here it's 5,400. We have a profit, but we only invested 25,000, half the amount. So we have a lower return on equity compared to a debt plan where we have higher return on equity. So this shows that we have more advantage if we borrow compared to if we don't borrow, the no debt plan. This gives us an idea why debt is an important part of financial statements, and their ratios are also to be seen and to be used in analysis quite largely. So what are the debt ratios? Debt ratios measures the proportion of total assets financed by the firm's creditors. So Total liabilities divided by total assets is the debt ratio, current ratio. We can see that this comes out to be the 1.6 or 1643 million divided by 3597, 3.5 million. That comes out to be 45.7%. So companies' total assets are almost half of it. Half of these assets are financed by the creditors. Now, the debt ratios varies with the industry. One cannot expect that 45 is a good figure or bad figure unless it is benchmarked as well as in a cross-sectional framework as well as on time series. We have to see if the industry debt ratio is falling and firm's debt ratio is increasing, then there has to be a caution and to look why it's happening. Now, debt to equity ratio measures the relative proportion of total liabilities and common stock equity used to finance the firm's assets. So debt to equity ratio, total liabilities divided by common stock equity, and that comes out to be, for the XYZ company, we have 1643 1754, and that comes out to be 93.7%. So for every dollar of equity, how many liabilities exist? Almost 100%. So the entire company is so for every dollar of equity, we have 93.7% of liabilities, or 93.7 dollars of liability exists. You can always do this ratio analysis through by putting 93.7 and 100, and you can see that for every $100, how many liabilities exist. What should be the good ratio? Should it be 1? Should it be 2? Or should it be less than 1? I leave it to you to look into this for a while. Later we are going to work on this comparison as well. Then we have times interest earned ratio that measure the firm's ability to make contractual interest payments, sometimes called interest coverage ratio. This is basically EBIT divided by, sorry, this is not taxes, this is interest. That's a misprint. So in our case, we can see that this value is 418 divided by 93,000 in interest. That comes out to be 4.49. So for every dollar of interest, how much profit exists? How much operating profit exists before paying interest and taxes? It's almost 4 times profit exists than what interest is paid, and it's a good position. It's a strong position of the company. Then comes to the next ratio, which is the fixed payment coverage ratio. The ratio looks a little bit scary. However, it's not that much. You can see that fixed payment coverage ratio measures the firm's ability to meet all fixed payment obligations. It's all about fixed payment obligations. So it's calculated by EBIT plus the lease payment and divided by interest plus lease payment plus this amount, principal payments plus preferred stock dividends, and 1 divided by 1 minus t. Basically 1 divided by 1 minus t, this is the tax, and we multiply by this figure. In fact, we divide by 1 minus t to bring back these figures to pre-tax level. So we know that preferred stock is paid after taxes, principal payments are paid after taxes. So what we do is we actually bring back these figures to pre-tax figures by actually dividing by 1 minus t. Now in our case, this comes out to be uh, 418 plus 35,000, and this comes out to be, and the lease payments is from income statement figures, and then we have uh, 93,000 plus 35,000 plus, and this we are going to multiply, so I'm putting brackets, and that is 71,000 plus 10,000, and then we are going to multiply by 1 over 1 minus 0.29, the tax, and then we are going to close the figure brackets, and then it comes out to be 1.87. The higher the better. Next, we look at the common size income statements. Basically, it means that we look at, we divide every figure by sales revenue, and we see how those figures are, and how they, what is the trend over the number of years. And we see that there is this given evaluation, and we can categorize it into better, worse, or no change or same. So sales revenue is the same for both years. No change. Cost of goods sold is worse. It fell down a little bit, and we can see it's worse. And then we have gross profit. It's worse. Although selling expense improved, maybe because of the large number of sales. They got certain efficiency in this area. And then you can see there's other issues are better. For instance, the lease expense, depreciation expense, operating margins, etc. Less interest expense improved, and so etc. So overall, the firm has done well, apart from cost of goods sold or the general administrative expenses. So this gives us an idea to look at different specific profitability ratios, and one in the on the top of it is the gross profit margin, which is sales minus cost of goods sold divided by sales. Basically, it means that it measures the percentage of each sales remaining after the firm has paid for its goods. So what we developed the cost of goods sold, we developed the product, we paid for it, and then we sold it. So it's sales minus what it cost to produce it. So this is the gross profits divided by sales. For every dollar of sale, how much gross profits we are making. And in this case, we have for XYZ company, we have, this is 3074 minus 2088000, and then that comes out to be 3074, and it comes out to be total of 32.1%. So for every dollar of sales, as I said, you can do it like this: 32.1 divided by 100. For every $100 of sales, we have gross profit of 32, which means around 70% is gone into cost of goods sold, which is fine. Depending on the industry and the cross-section, times the cross-section in time series analysis, we can pick that the company is doing well or not. Please remember that this 32% of the gross profit margin will be utilized to pay for operating expenses and the other expenses, including the taxes. So the larger it is, the better, because it will be substantially reduced over the as we move down the income statement. For this purpose, let's look at the next ratio, operating profit margin. It measures the percentage of each sales dollar remaining after all the costs and expenses other than the interest, taxes, and preferred stock dividends are deducted. So basically, operating profits divided by sales. And this comes out to be, for XYZ, is 418,000, around half a million, divided by 3 million, which is total sales. 3074 comes out to be 13.6%. And as I said, you can 13.6 divided by 100. For every $100 of sales, we have been left with 13.6% of operating profits. So this 13.6% will be further reduced as we move, but right now we have uh, um, subtracted almost all the expenses, operating expenses. We are left with only interest, taxes, and some dividends. Let's look at the ratios for those. Net profit margin, it measures the percentage of each sales dollars remaining after all the cost expenses, including interest, taxes, and preferred stock dividends have been deducted. So everything is gone, only earning available for common stockholders divided by sales. So this figure comes out to be and this is sales is 3074, comes out to be 7.2%. So for every $100 of sales, we have been able to earn $7.2 for common stockholders after paying almost everything. You see, we started with a higher ratio, 30% of the gross profit, and comes out to be 7.2% in the end. Now we have other ratios that can actually gives us more insights about the firm's financial state. This includes earning per share. EPS is one of the most famous ratios, and it represents the number of dollars earned during the period on behalf of each outstanding share of common stocks. So basically, earnings available for common stockholders and number of shares common stock outstanding. So for XYZ company, we have this earnings available for common stockholders is $221,000, and number of shares we have 76, which we pick up from the balance sheet to 62. If there are certain adjustments made, we can also look at for these adjustment or find those adjustment in the footnotes of the income statement, and we can see that it comes out to be $2.9. Now for every dollar, for every stock, we are earning $2.9, or they are at least available for the available for common stockholders, and higher the better. Then comes the return on total assets. Basically measures the overall effectiveness of management in generating profits with this available assets. We calculate it by dividing the earnings available for common stockholders by total assets. For XYZ company, this turns out to be the $221,000 divided by 3.59, or let's put it comma 3.7, and that comes out to be 6.1%, which means for every $100 of assets, $6 of earnings are generated, which is normally for the mature firms. So let's put it to a proper context. Large and mature firms will have more total assets, while they are less efficient in generating earnings, while small firms will have fewer assets but more efficient in generating earnings. So this ratio will be higher for new ventures, small firms, and will be small or little for large firms and large and mature firms. Now let's look at the return on equity, which measures the return earned on common stockholders' investment in the firm. This is calculated by dividing the earnings available for common stockholders and divided by common stock equity. So for XYZ company, we have this is $221,000 divided by 1,754 million as the common stock equity comes out to be. Now equity is in dollar, not common stock outstanding. It's the common stock equity. So number of stocks multiplied by the stock price. and that comes out to be 12.6. 12.6%, which is fairly good. For every $100 investment in these firms as an equity, the firm will give you a return of 12.6%. The higher the better, and also has to be benchmarked to the industry and the time series trend. Now we look at market ratios related to the price to earning ratio. Very, very known and important ratio. It measures the amount that investors are willing to pay for each dollar of the firm's earning. Now market price has certain history, and we need to understand this in proper context. The stockholders or the market actually price the stock by by understanding the information in the financial statements or the industrial changes or the economic changes of the country and how it will affect the specific firm. Now the firm also have future projections, what they will do. They will have new projects, they will grow in size, financially, economically, etc. They will increase their size through increase in sales. So all these information is being gathered by the market participant, and they put a price on the stock of the firm. Now basically they lend their credibility on the company's strategies. Now if the price is higher, the company, if the market thinks that the price should be higher, this means that the company has added a lot of value, or they will be able to add more value. If the market puts a lower price on the stock, this means that the company strategy is not consistent with the market expectations, or it's unreliable or less credit worthy. Hence, the market is not paying for what the firm is demanding. So price is an important factor. Price comes through demand and supply mechanism in the market, and a price increase means that the company has been able to show that it's doing well and it will do well in the future. And a fall in price means that the market thinks that the company is not doing well and it will not do well in the future. Keeping this context, let's calculate this ratio. And for example, if the XYZ company common stock was selling at the end of the 2015 at, let's say, the price was at 2015, and which will be around $32.25 in the market. Now if we have EPS, earning per share, which we calculated earlier on, was, if you remember, it was $2.9, and if we use this in this ratio, we'll have 32, the market price, divided by the earning per share that the firm itself calculated. It comes from the income statement directly. That is 2.9, and it comes out to be 11.12 times. So P is the ratio, and it says that the firm's earning are priced higher, and also if this is higher the better, lower the worse. So higher the ratio means they will be the company, the market is putting a lot of confidence in the firm, although their earnings are lower. So the future earnings of the firms should be higher as per the market price indicates. Let's look at the other ratios, market related ratios. So the first one is the market to book ratio. It is actually calculated by market price per share. So market price of the stock divided by per share of common stocks, the number of common stocks you have to use, and the book value per share of common stocks, so divided by common stock per share. So it's basically market price divided by number of shares, and book value divided by number of shares. So if market price is quoted as per share, so it's already done you don't need to divide it again. But if it's not given as per share, then you can compute it by dividing by total number of shares. Now, what is book value per share? It's also shown here, and you can see that it is the common stock equity divided by number of shares of common stocks here. So book value basically means the common stock equity, which is stated in the financial statement at an historical basis. For our XYZ company, we can calculate first the book value, and the book value is so book value per share, and that comes out to be equals to 1754 million, and that comes out to be 76,262. That's total number of shares outstanding, and gives us $23. Now, if we substitute in the market to book ratio, we get market value of the market to book ratio. That gives us market price, if you remember, per share was $32.25, and this is the book value that we got, and it comes out to be $23, and it comes out to be 1.4. Now, $1.4. Now, $1.4 is a positive figure, which means market is actually lending higher credibility to the company future compared to what it holds in its financial statement. So book value is what it holds in its financial statement. Market tells us that what is its future, how much it has the earning capacity in the future. So market is about future, book value is about historical. If this ratio is the other way around, which means if it's less than 1, which means you have a higher book value, you have a dead assets in your financial statements, or what we call white elephants, and market is not buying into the idea that these assets will be able to create value in the future. So you have to look at this ratio quite deeply. This is the overall summary of XYZ company ratios from 2010 to 15, and we can see that based on liquidity, activity, debt, and profitability, they are divided. And also in the other slide, we have other ratios as well. And what we can see is that we can create this kind of an evaluation. This is not a standard evaluation. You can do your own. So we divide into 3-4 things. We can say scale could be good, okay, bad, or poor. And you can divide into 5 categories also to better estimate the results or compare the results. So you can see there are certain ratios where the firm is doing really well in all aspects, really bad in all aspects. And when you see this, that there is a concentration of very bad, you have to actually, it provides you an opportunity to look into it and find out what is actually happening and how to actually find the problem and solve it, provide a solution for that. If you go there, there's profitability and market ratios as well, the one that we have discussed, and we can see that they are doing very well in this area. Also, it's okay, it's not a bad performance either. So the idea is that they are not doing well in activity area, and especially they have a problem in collection and payment periods. So we have to look into it, why their collection and payment periods are not consistent with the industry and why they are doing poorly, and how they can amend it and how they can improve it. So let's look at the DuPont system of analysis. DuPont system of analysis is used to dissect the firm's financial statement and to assess its financial conditions. So it's basically dissection and assessment, and we'll look into this a little bit later more deeply. It merges the income statement and balance sheet into 2 summary measures of profitability. ROA is calculated through net profit margin, which is earnings to sales, and total assets turnover, which is sales to assets. We'll look into this in a few moments. Then there is another one which is called modified DuPont, which we will also look at. And the modified DuPont formula basically relates the firm's return on total assets to its return on common equity. And we'll look into this by using financial leverage multiplier. We'll look into this in a few moments. First, let's look at DuPont system. So DuPont system is basically ROA equals to earning. We have net profit margin, net profit margin that we discussed, and the other one is this. This is the total asset turnover. Total asset turnover. Now, if you see this, if you cancel the sales from both ratios, we have earnings to total assets. So for how many, how for every dollar of assets, how much earnings are available for common stockholders if you cancel the sales. So we have this ratio, which is how many earnings, how much earnings are available for every dollar of assets in the firm. However, when we dissect into two parts, we get a very fair idea. And let me rub it, and let's look at this now. Earnings available for common stockholders to sales. For every dollar of sales, how much earnings are available, and for every dollar of assets, how many sales are being generated. Now let's look this into a specific context. We increase the earnings and keeps everything constant, so this ratio will increase. If this ratio is increase, this ratio stays same, so the company with its existing sales and assets has created more earnings. That will be the interpretation. But if sales increases, earnings remains the same. Earnings remains the same. I'm putting a cross to say that it remains same, while total assets remains the same and sales increases. So if sales increases, this ratio will become smaller, and hence higher sales are actually not efficient in generating more earnings. And this side, the total assets are the same. So the efficiency has increased in creating sales, but translating sales to earnings is not happening here. So you can see, if you change a single variable, you see, and keep the other constant, you can have a very nicely oriented interpretation for return on asset through DuPont system. And that's what the purpose of DuPont system of analysis is, so that you can play around with the variables and you can see how they react, and keep some constant, the other changes, and how it works and what will be the interpretation. Let's look at the example for our XYZ company and in DuPont system. It will have, we already calculated, this is 7.2% is the net profit margin. And if you look at your earlier notes, you can see that its asset turnover was 0.85, comes out to be 6.1%. So now it's not that important. We could calculate 6.1% directly, but what is important is to understand what's happening inside this 6.1%. Who is responsible, or what is responsible for this 6.1%? If it's a lower figure, we have to look at it that there is asset turnover probably is creating a lot of problem. It is lower side, or it could have been higher on the net profit side. But but here it's most likely the total asset turnover which is creating a problem for lower ROA. Again, it depends on, once we benchmark it to the industry, and also look at in a time series sequence to see that if the trend is actually this favoring 6.1% or is not favoring 6.1%. In the modified DuPont formula, we simply multiply the ROA, return on assets, total earnings to assets ratio, and the financial leverage multiplier. What is this financial leverage multiplier? Basically, modified DuPont formula relates the firm's return on total assets, which is ROA, to its return on common equity. So the later is calculated by multiplying the return on assets by financial leverage multiplier, which we saw here, and it is actually this figure, and ROA is this one. So financial leverage multiplier is basically the total assets to common stockholders, which means for every dollar of equity, how many assets, total assets exist? How many total assets exist? So the entire formula becomes here common stock equity to, if we cancel total assets, so it's basically for every dollar of common stock equity, how much earnings available. So this formula, for every dollar of common stock equity, how many earnings are available. So it becomes the return on equity. That was return on asset. This is now return on equity. For our XYZ company, it becomes the obviously we are going to have the ROE equals to ROA multiplied by FLM, and this gives us the 6.1% multiplied by 2.051, which is the financial leverage multiplier, which is again the total asset to common stock equity, total assets to common stock equity. I'm abbreviating it just to save space and also the writing effort. So that comes out to be the 12.5%. Now we are not interested in 12.5%. What we are interested in is which component is causing a problem in 12.5%. So for every dollar of common stock equity, we have $2 of assets available. Now, if you have high number of assets available, then these assets should create higher number of return or earnings, but it's lower. So where is the problem? Either the problem is in return on asset, or either the problem is in FLM. If FLM doesn't have a problem, then most likely it's the ROA which has a problem, which means our earning efforts are questionable. Look at the system. The structure is neatly given here. We have this income statement, and this is the balance sheet, and you can see these are the these boxes are structured in a similar way as income statement, and these are the balance sheet. If you look at it, that why DuPont system of analysis is so much important, because all the crux or all the conclusion of each accounts turns out to be here and here. So if we have to look at ROE as 12.65%, and we have to see that whether it's is the right figure or there is a problem, we can go first to see, dissect into ROA and financial leverage multiplier. We can see that financial leverage multiplier is based on this and this, and so we can move forward and we can see that if the problem is here, or we can go in return on asset where there is net profit margin and total asset turnover. Then we can take this direction and we can take this direction to find out the problem and fix it. If we fix that problem, our ROE will be fixed. It will be improved, or it will be it will do well. So that's all about DuPont system of analysis. A very interesting, a quick way of understanding or finding a problem in financial statement. And so it's pretty handy to have ROA and ROE both known to you, and should be asking these questions whenever you look at financial statement. What is the ROA of the firm, and what is the ROE of the firm? And then you can see that what is the financial leverage multiplier. You can also find the unknown variables if you have other variables known to you. This will help you to quickly assess the firm's financial statement, their financial situation, and cleverly ask questions where the problem is and how to improve it. So we did finish with our all learning goals in this two-part series. The second part specifically worked on the relationship between debt and financial leverage and ratios. Also, we looked at the analyzed firm's profitability and market value. This was very important because market put a price on, market put credibility or confidence in a firm's strategy, its future projects, and based on all the humanly possible informative variables such as economy, industry, international politics, etc. Everything has been taken into account before looking at the market value, before pricing the firm's stock. And if it's higher, obviously the market think that the firm has what it takes to create more value in the future. If it's low, it means it won't be able to create value. It won't be able to resist the challenges in its ecosystem, or its internal issues, resolve internal issues, etc. It will be quickly revealed in market price. Then we looked at the summary of financial statement. We actually look at the financials DuPont system, and here we have looked at the ROA and ROE, which are the very important two ratios or system of ratios. ROA tells us return on assets, um, and net profit margin and total asset turnovers make up ROA, while ROE is the modified DuPont system and uses FLM, financial leverage multiplier, to calculate it. So let's finish this presentation here. Thank you.